/CHN. Good evening, everyone, and welcome to today's market analysis. The past trading session saw global risk assets characterized by a significant sell-off and shakeout, a scenario we assigned a 70% probability. After hitting all-time highs just the previous day, the U.S. major indices reversed sharply, with the Nasdaq Composite leading the decline, closing at 26,225.14 points. The S&P 500 settled at 7,408.50 points, and the Dow Jones Industrial Average finished at 49,526.17 points. The VIX Volatility Index also rose to 18.43, clearly signaling concentrated profit-taking at elevated levels. The central theme of capital flow has become exceptionally clear. We've observed a massive outflow of funds from high-valuation technology stocks, particularly semiconductors. These funds are predominantly moving in two directions: first, into energy commodities, which serve as a hedge against inflation and geopolitical risks. WTI crude, for instance, has breached the $102 mark, closing at $102.38 per barrel. Second, cash assets are gaining significant appeal as the 10-year U.S. Treasury yield surged to 4.59%. The market is voting with its feet, formally initiating the pricing in of a normalized high-interest rate environment. Reviewing the global market trajectory, the Asian session was the first to sound the alarm. The South Korean stock market plunged due to the collapse in share prices of chip giant Samsung and SK Hynix, becoming the starting point for a global tech sell-off. This sharply contrasted with the previous day's optimism in U.S. equities, signaling a turning point for global risk appetite. European markets, however, displayed a notable lag. As Asia began shedding tech stocks, European equities continued to rise, driven by their tech sector, completely detached from the global shift in risk sentiment. Upon opening, the U.S. market fully mirrored Asia's pessimism, disregarding Europe's brief optimism. Tech stocks immediately came under pressure, leading to a day of volatile declines, with no significant dip buying activity observed towards the close. Ultimately, U.S. indices finished near their daily lows, confirming the bearish signal from Asian markets. We must conduct a profound self-reflection. Previously, on May 13, we assessed tech stocks as strong yet structurally fragile, assigning a bullish probability as high as 75%. However, the market reversed into a decline the very next day. This indicates an underestimation of the market's fragility in a high-interest rate environment and a significant misjudgment regarding the magnitude and speed of the reversal. The core error lay in underestimating the disruptive impact of the 30-year U.S. Treasury yield breaking above 5%. This isn't merely a number, it signifies a fundamental shift in the global asset pricing anchor, exerting systemic pressure on all long-duration assets, especially high-valuation tech stocks. Currently, new structural signals have emerged with an 85% probability. Firstly, the 30-year U.S. Treasury yield holding above 5% confirms that the global market is entering a new paradigm of high interest rates and high volatility. Secondly, the decisive and substantial rotation of capital from tech stocks to energy commodities indicates that the market is no longer defined by a single growth or value style. Instead, it has split.